Let's talk about the strategic profit model. We use the strategic profit model to demonstrate logistics' impact on your firm's return on assets, or ROA. Back in the 1920s, the financial analysts at DuPont Chemical wanted to come up with a way to show how, and how well, your firm earns returns on invested capital. The result of their efforts is what we call the DuPont, or strategic profit model. The strategic profit model is powerful for two reasons. First, by working backward from return on assets, you can show how your decisions will affect your firm's ability to make money. Second, you can also compare alternative decisions to see which will provide better returns. This will help you to know which decision-making levers to pull to achieve the best financial results. Let's talk through the strategic profit model to see how it works. The key point that you need to remember is that the strategic profit model breaks ROA into two main components: profit margin, a measure of how efficiently you generate profits, and asset turnover, a measure of how quickly you turn assets into sales. If you can increase your profit margin, or if you can convert assets into sales faster, you can increase your return. Now here's a key takeaway. The margin information on the top half of the model comes from the income statement. The asset information on the bottom half comes from the balance sheet. Thus, the strategic profit model provides a holistic view of how your decisions affect returns. Let's give you a moment to take a look at your simplified financial statements. You are going to pull all the data needed to calculate ROA from these statements. As a logistician, your decisions will affect the logistics costs and inventory levels on the far left or input side of the strategic profit model. Further, because logistics influences service levels, your decisions will also affect customer satisfaction and thus sales revenue. As you work to the right, you can show how your potential decisions will affect the issues top management cares about, that is, margin, asset utilization, and ROA. Of course, before doing anything, you need to calculate your baseline or starting position. Let's plug the numbers from your financial statements into the strategic profit model and see how it works. You see that your initial ROA is 13.42%. How did we get this number? Let's begin on the left with the margin side of the model. You start with your sales revenue and subtract out your cost of goods sold. That gives you your gross profit. From your gross profit, you are going to subtract out your other costs. Those are your operating costs. They include logistics as well as other expenses such as sales and administrative costs. You'll also have to subtract out your taxes and interest expense. That leaves you with your net income. Now simply divide your net income by your sales to get your profit margin. In this case, 7.06%. Now let's look at the turnover side of the model. First, you add up all of your current assets. These include cash, accounts receivable, and inventory. Now add your current assets to your fixed assets to obtain your total assets. When you divide sales revenue by total assets, you get your asset turnover. In this case, 1.90. The final step is to multiply your profit margin by your asset turnover. That is 7.06% times 1.90. The result, 13.42% return on assets. Now you know how the strategic profit model works.